After discussing about the merchant banks and the venture capital, which are the most important or non-banking financial companies which play the significant role for the financial development, we can discuss about the credit rating agencies today, uh, whose role is quite significant in terms of the investment in the financial market, and as well as from the investor point of view to look for certain companies who are good for the investments or who are basically eligible for the investment in the financial system. So, let us see that what do we mean by the credit rating and what do we mean by the credit rating agency. Whenever we talk about the credit rating, it is basically what? The credit rating is basically a process. It is basically evaluation of the credit worthiness of a debtor. Especially, it can be for a company or the corporation or for a government. So, you see that basically what? Whenever we are trying to find out the credit worthiness of a particular entity, whether that entity belongs to a company or it belongs to a particular organization or particular country. So, there whether that particular company is able to repay the loan or not, or if the company is issuing the debt, whether what kind of credit risk is involved with that particular company. So, those things can be judged on the basis of the whatever rating the company has. So, credit rating basically gives you kind of qualitative idea about the company, what kind of that company is and whether the company is able to repay the loan in the future or not. So, that is why or whatever debt the company has issued, whether the company is able to pay the periodical coupons and as well as the principal in the end or not. So, that is basically measured through a process which is called the credit rating. And the ratings are always given, the ratings are basically given in the alphabetical sense, or we can say that A, B, C kind of process, the ratings are always provided. So, here that is why these are the numerical alphabetical or the numerical symbols always we give for the different type of ratings what we give to the different company or the country. And who gives the rating? The ratings are basically given by the credit rating agencies. So, here the rating agency considers certain kind of factors, certain kind of they follow certain kind of process, and following that factors or using that factors and following that process, they try to find out that what kind of rating the company will get, or they try to give a particular rating which measures the qualitative measures of the credit worthiness of that particular company. So, here what they basically try to make or try to always measure, they try to measure the debtor's ability to pay back the debt. And already you know that whenever the company has gone for the debt financing or the bond financing, always there are two major components. One is your interest payment and another one is the principal. And they consider whether the company is able to repay the interest in the periodical manner or not, that is number one, and what is the probability of default the company might have or may have to pay that particular interest in the future time. So, this is what basically the basic job of the credit rating agency. So, in India we have different kind of different types of agencies, or there are many agencies which provide this kind of ratings, and internationally also we have many credit rating agencies which provide this kind of ratings to the company. So, according to CRISIL, if you see, CRISIL is a credit rating agency which gives the credit rating is an unbiased and independent opinion as to issuers' capacity to meet its financial obligations. It does not constitute a recommendation to buy, sell or hold a particular security. The CRISIL, according to CRISIL, the rating agency basically does not give, a credit rating does not mean that you invest in that company or you buy in that company or you sell in that company, so sold that particular stock or buy that particular bond or sell that particular bond. Those buying and selling of a security provided by that particular company in terms of debt financing or equity financing, that is not basically the rating tells. What the rating tells? The rating tells that whether the issuer has the capacity to pay these financial obligations whatever they have. If they have issued the debt, if they have issued this bond, whether they are able to repay this coupon and as well as the principal in the future or not, that thing basically you can judge on the basis of the rating what the company gets. But it never says that whether you should buy that particular stock or you should sell that particular stock or you buy that particular bond or sell that particular bond. So, those kind of things are not basically always we judge whenever we get this credit rating. So, according to Moody's, which is a global player, what this Moody's tells, the ratings are designed exclusively for the purpose of grading the bond according to the investment qualities. So, there are two types of broad categories of the bonds always we observe or we find in the market. One is investment grade bonds and other one is not investment grade bonds. So, investment grade bond means up to a certain rating the bonds are considered as the investment grade bonds which are eligible to be traded in the market, and those from those bonds the investor can participate in the trading process of those type of bonds. And another type of bonds are those which are basically not eligible for the trading in the financial system or the financial market. So, therefore, whether you want to buy this particular stock or buy this particular bond or you sell this particular bond, that is not basically we can judge from the rating, but we can get this overall idea that what to basically what kind of the company it is, whether the company has the credit worthiness to meet its financial obligations in the future or not. This is what basically the rating agency's job is, or this is the objective of the credit rating what we can say. Why we need a credit rating? Already we say that the basic use of rating is to get this idea to get this kind of information whether the company is able to fulfill the financial obligation or not. So, this is what basically the financial obligations are basically always met by this particular company in the future or not, that is basically judged by the credit rating rating from that particular company. So, why we need the rating? Basically, if any company gets a good rating, the confidence of the investor to invest in that company increases, or the probability of the investors' confidence on investing in those kind of bonds or those kind of companies stock may increase. So, that basically always help us to create a confidence in the investor's mind that whenever they are going to take a position in the financial market for a particular bond or particular stock, then whether the particular stock is going to do well in the future or not, that particular kind of implications they can draw if the rating of the company is better or it is a good rating the company has got. So, the investor's confidence is always maintained if anybody uses or anybody gets a good rating of that particular company where the investor invests. It protects the interest of the investors, because all those information the investor may not get. So, all those always investor feels that all those investor whatever information the investor want to get for investment, they may not have all those information, but all the informations are reflected through the rating what the company has. So, because of that it protects the interest of the investors. Then motivate the savers to invest, because if the there are certain people are relatively risk averse in nature and they do not want to take the much risk in the financial system. In that particular point of time, if they realize that one company's rating is better and the credit worthiness of the company is quite high. So, in that context they may be motivated to save more, and that savings may be sometimes those savers can be converted into investors in the market and they can participate in the capital market for the investment, both in terms of stock investment and as well as the bond investment. Mostly they will be at least they will be interested to invest in the bonds. So, that is basically a motivation which is created in the mind of the savers to become the investors. So, that is another thing what you can judge whenever we talk about the credit rating, or this is the requirements, the reasons for the credit rating always we can say. So, there are certain advantages always the company get. The rating is required from both investors perspective and as well as the company's perspective. And what are those advantages of credit rating for the company? Why the company wants the credit rating? What are the basic reasons behind that? First of all, it helps us to create the image within the corporate sector. Any company gets good rating is good, then it creates a good image in the market. And there are certain companies, they are not quite popular. The information about the company is not available to the common man or the common mass. So, in that particular point of time, if the investors are little bit reluctant to invest in those kind of companies or the particular bonds or stocks issued by these companies, then how basically they can get this information whether the company is good or bad. So, that basically information they can always realize or always we can get, they can get from the ratings of that particular company. If the rating is good, it is creates an impression that the company must be good. It is a good company, that is why they will be ready to invest in that particular company. Then also it acts as a marketing tool. Some company always uses that rating as a marketing tool, because they always feel that okay, my company is a triple A rated company or my company is a double A rated company. So, it is a rated company. So, that basically always they can use to market themselves in the financial system or to attract the investors that okay, this company is a good company and this company is better for the investment in the future. Reduces cost of the borrowing. The reason is higher the ratings relatively because of good reputation, because of the good brand value, because of less probability of default, the borrowing cost of those companies basically reduces. And another one is easy to raise the resources. If the company wants to raise the money from the market or they want to raise the money from the public, and if it is a good rated company, then always it motivates the people to invest, and as well as whatever bonds this company will issue, and it is easily subscribed in the financial market, or the investors will be ready to buy those kind of bonds whatever thing are issued by these particular companies. The bond issuance will be relatively easier, and this companies basically get the good price for that particular bond, and it will be easy for them to raise the resources from the system. And it also helps in growth and expansion. Because the company's rating is good, what can happen in that process? It is then easy for raising the capital. So, if it is easy for raising the capital, particularly we are referring to the financial capital, because the financial capital increase is relatively better, then the company can grow and they can expand in a better way, because the enhancement of the financial capital lead to the enhancement of the physical capital. They can create the infrastructure, they can create the machines and all these things to grow themselves or to make some expansionary plan for that particular company. So, that is why it also helps in the growth and expansion. So, these are the major advantages what we can realize or we can observe from the company's perspective that why the company needs the credit rating. From the investor's perspective, it helps in the investment decision. It helps that which company they should choose. They can easily understand the investment proposal, and they can always find out what is the credibility of the issuer, the qualitative credibility, whether the issuer is really able to pay the coupons and principal in the end or not. And because the credit rating companies, credit rating agencies rate these companies periodically, whatever rating the company gets, there is a validity period of this particular rating. So, whatever rating the company gets, maybe that is valid for 1 year or 6 months, and after that again the rating will be done and the same process will be followed, and the rating may sustain, rating may increase, rating may decrease. That is why what these investors always feel, that if the company's rating is consistent or the rating is getting better and better, then maybe it is good for them, or that means it is continuously monitored and the company's performance is going to be better off. So, if they are going to take part in the investment process with respect to that company, maybe it is better for them or profitable for them to maximize their returns. So, that is why it basically has a continuous monitoring process. Because credit rating is a continuous monitoring process, the investor can rely that whatever on the basis of the rating, they can judge that whatever company it is, whether it is a good company or it is a bad company. Then which are those credit rating agencies in India and abroad? If you see, we have 5 major rating agencies. One is CRISIL, already I was just telling about this thing, Credit Rating and Information Services India Limited. Then we have Investment Information and Credit Rating Agency Limited, that is called ICRA. Then Credit Analysis and Research Limited, that is called CARE. Then you have the Brickwork Ratings India Private Limited, that is another rating agency. Then SME Rating Agency of India Limited, that is called SMERA, SMERA. There are some global players we have, Moody's, already I told you, we have Standard and Poor, we have the Fitch Ratings. These are the companies or these are the rating agencies who give the ratings across the globe to the companies and as well as to the country. The country governance and all these things or the rating of the company for the investment, all kind of things are done by the global players, and they also do the rating for the corporates for their bond issuance. So, these are the different kind of agency. So, if you see that rating process, how this rating process basically works. The rating process means any company who wanted to be rated, So, let any company wants that okay, I should get some credit rating for the credit rating agency. Then what they do? The client basically who wants the rating or the company who wants the rating, they send a request to the rating agency for the rating, and the rating agency what they do? They sign a agreement all those with all those information, rating fees, because they will give the rating to the company, that is why some rating fees they will charge, and one agreement will be signed. Then once those things got over, then what will happen, that the rating agency, in this case we are talking about CRISIL, the CRISIL basically assigned a team, and the team basically collects the information from the company, the products, whatever product the company is producing, and whatever financial strength the company has, all those preliminary analysis basically they will do. Then after getting all those information by this team, they can interact with their top management people with the rating agency and as well as the company. Then after that, all those analysis whatever they will make, that will be presented in a rating committee, and the finally on the basis of the different parameters that we will discuss, the rating parameters one rating will be assigned and that particular rating will be given to the issuer. If issuer will accept this rating, then that will be published in the website, that this is the rating what the company has. If the issuer does not accept this, then what will happen? The issuer, the particular company can appeal against this rating, and then what will happen? Again this rating agency may look at those things, but still the details of unaccepted ratings disclosed on the website, and whatever rating the company got, that also will be reflected in the website, but this rating basically kept under surveillance during the tenure of the instrument. Because the rating has been given for 1 year or so, the rating agencies also always monitor the situation of that particular company. They look at, because the company's performance and everything should be under surveillance to ensure that whatever factors or the parameters they consider to provide this rating, those parameters, factors, everything should not be changed frequently, or they should not be deviate from the target level by a larger extent. So, because of that, the monitoring also happens through that. So, finally, one rating will be given to that company, and the rating will be always shown in the website. Then how the companies basically give the rating? The ratings are basically given to the company using the different analysis, different factors they consider. What are those? They do a business analysis, they do a financial analysis, they go for analyzing their management, geographical analysis also they do, the regulatory and competitive environment of that particular company, then some of the other fundamentals. So, these are all type of analysis the rating companies always do whenever the ratings are provided or ratings are given to the different entities or the different type of companies. Then how it is basically done one by one, if you see in the business analysis what they do. All of you know that the business means what? How this sells. The business risk, if you consider, the business risk is nothing but how the sales figure of that particular company or sales income of that particular company is going to be affected. So, if this is the sales is the parameter through which the business risk of that particular company can be measured, then which are those factors which are affecting the sales? One is the industry risk of that particular company under which the particular company belongs, the market position, the market share and all these things, whatever the company's position is now and how the company is going to grow in the future. What is the operating efficiency of the company? Is there any kind of legal battles the company is company has, or is there any kind of bigger cases in terms of fraud or in terms of other activities which is already going on with the company? That is legal positions, whatever the company's legal position has. Size of the business, whatever business the company is doing, then what kind of business, what is the turnover and all these things, that also has to be looked upon in terms of the business analysis. So, they look at the risk aspect in terms of industry risk, they look at the market share, they look at the efficiency of the company, operating efficiency of the company, they look at the legal aspects, whether the company is busy with or maybe involved any kind of fraud or any kind of legal cases are going on for that particular company, that thing basically they look at. And finally, the size of the business also always looked upon, which are the part of the business analysis. Then we go for the financial analysis. In the financial analysis, mostly they look at the different ratios. What are those different factors or different ratios which measure this financial performance of the company, that also has to be looked upon. They look at the accounting quality, profitability ratios. Profitability ratios means we are referring the ROA or ROE, ROCE, all these things. they look at what is the profitability, they look at the cash flow, inflow and outflow, and you know that their cash flow are many times cash flow from the financing, cash flow from the investment and cash flow from the operations. Operating cash flow, financing cash flow and investment cash flow, these are the different type of cash flow. They do the cash flow analysis of the company. Financial flexibility, that is basically measured through your debt equity ratio mostly. If debt equity ratio is more, then flexibility of the company is relatively less. If the debt equity ratio is low, then the flexibility of the company is high. So, these are the different, mostly I already told you, these are the ratio analysis the companies do, sorry, the credit rating agencies do in terms of the financial analysis. Then we can see that what are the other things, evaluation of the management, what is the goal of the management, what are the strategies the management is going to adopt in the future, or whatever the strategies they are now adopting. Is there any kind of capacity they have to overcome the unfavorable conditions, if there is any business cyclic fluctuations, any kind of recession or any other thing which can happen in the market, whether they have capacity to overcome that. Planning and controlling system, whatever plans they are making and what is the control system they have. Then in terms of geographical analysis, they look at whether it is a domestic company or a multinational company. Even if it is a multinational company, whether the geographical advantage the company is enjoying or not, or they have chosen a particular region, whether the region is basically providing good subsidy for the business in that particular place or particular domestic part. So, these are basically a part of the geographical analysis. Then we have the look at the competitive structure environment of the particular country, regulatory environment of that particular country, like structure, the regulatory framework, licensing policy, the taxation policy, and all these things has to be looked upon. Then the fundamental analysis, they always look at the liquidity management, asset quality, what is the quality of the asset, mostly it is applicable for the finance companies, profitability and financial position, interest rate, tax sensitivity, how the interest rate and tax, if that will change, how the profitability and other things of the companies are going to be affected. So, that sensitivity also they try to check. Then if you divide this kind of thing into two parts, one is rating for the financial institutions and another one is for the manufacturing and other companies. If they are going for the banks and financial institutions rating, the rating agencies look at the capital adequacy ratio, that already you know, capital upon total risk weighted asset, whatever resources raising ability the company has or the bank has. Asset quality, that means already we have discussed that, whether the asset has standard, substandard, how much NPA and all these things. Management and systems evaluation, they look at earnings potential in the future, how much cash flow the particular banks and all these things can generate, and how their asset liquid or asset liability management they are basically making. These are the part of the banks and financial institutions. These are the parameters they look at whenever they give the rating to banks and financial institutions. But while coming to the manufacturing companies, the whole process has to be followed. Industry, market position, operating efficiency, look at it is business risk. Competency, integrity, risk appetite, it is a part of the market risk. Accounting, quality, financial position, cash flow and financial flexibility, these are comes under the financial risk. So, once you have add up everything, then on the considering all those factors, then they look at how the company is going to perform or how they are performing now. The overall rating will be given accordingly. So, if you see some of the example, the CRISIL is giving the CRISIL AAA, that means the highest safety, AA high safety, like that. Then if you go by the CRISIL D, it is a default bond, which is the most substantial bond which is available in the market. So, this is the way the ratings are given by the different companies or different rating agencies give the different symbols. So, then if you want to, for this session you can go through these references and the website of the CRISIL to have the better idea about the nitty-gritty of the credit rating. Thank you.